Hello and welcome to a brand new episode of Smart Money. Now, since it is the start of a new fiscal, we thought that we should put together a plan for you to invest into 5 or 6 important products that you need to have in your portfolio. Of course, these could be the same old products, but it is never too late to revisit old and classic concepts. So our expert today is Anand Dalmia, who is the co-founder and chief business officer at Fisdom. Prior to that, he was with UBS for a while as well. Anand, thank you so much for joining us. And he has been a regular on our channel too. Anand, there are 5 or 6 products that you're going to talk about. So let's get straight to it. Mutual funds, right? Just want to start with that. In FY24, how are we placed? Because this has been a very challenging year. Any investor you speak to will say the last 3 years my returns have been subpar and, really nothing to speak about.
Yep.
So is it still a good time?
Look, I think, to invest in mutual funds any time is a good time.
Yeah.
It all depends on what your purpose is. So, if you look at the majority of the investors, they invested in balanced advantage funds. And the reason they've not made returns is because that portion of the balanced advantage funds didn't actually make the returns, right? So we generally tell our investors that be there for 5 years or more. And I think while the debate is out, whether active versus passive, we still believe that, mutual fund is probably the most tax efficient manner to make the best returns. Now, the categories that people choose depends on their risk profile, but the simplest categories are the multi-asset, the flexi cap, and the balance advantage. I would say people should get into it depending on what their risk profile is. Secondly, I would say we should follow some fundamental principles. Like, we keep talking about diversification, asset allocation, and don't do everything at a go. So don't put all your money at a go. So what I mean by that is try and do an SIP, or if you have a lump sum, then try and do it in an asset allocation fashion, rather than say, okay, I'll do it in equity and then I'm looking at returns on a daily basis.
Okay. So you know what, in this day and age of like Google and Google Maps and AI and ChatGPT, people want all their work to be done for them, right? So we keep getting queries about what we should invest in terms of mutual funds. Which are the funds to invest in? Don't just tell us invest, but tell us the name of the funds. So if you had to pick out 2 or 3 mutual funds that one can look at, perhaps for the next 1 to 2 years, which ones would they be and why?
Look, 1 to 2 years is a slightly difficult one because we just generally tell people invest for a longer period of time. I would say on the balance advantage, again, the category, if you want an asset allocation, balance advantage, we like ICICI Pru balance advantage a lot. Multi-asset is something very interesting now that people want a bit of gold also there. So, if you want debt, equity and gold, go for multi-asset. I think we like the SBI multi-asset fund a lot. And my personal favorite for people who want to invest in SIPs is, and if they want diversification, is the flexi cap category. Within that, we like Parag Parikh because it also has got an international flavor to it. And we also like the Kotak flexi cap.
But the issue with the Parag Parikh International Fund is, right? I mean, it's underperformed so much. It's caused a lot of frustration to investors, especially after what's happened with big tech stocks in the US. You still like that fund?
Look, I am a big bull on NASDAQ per se. I generally believe that, look, it's a great time. If you look at Facebook 3 months down the line, or 3 months earlier, I would say, it's almost moved up 100%, or Meta as we call it now. So I believe that tech is going to come back. Obviously because of the cost of funds, I think tech has taken a beating. But last 3-4 months, NASDAQ has recovered almost 30%. So to get a flavor of it, to make sure that if it was to come back and you want to create that alpha, I would say Parag Parikh and international equities is a good 15% that you should invest in.
Okay, so that's about mutual funds, and we'll come to that in a bit. But I believe one of the most underrated and effective ways or products to invest in is the National Pension Scheme.
Absolutely.
So for people who have not invested yet, tell us about that.
Look, as a salaried employee, most of us don't have a way to save tax, right? So the 180C that we always invested in is like 1.5 lakhs forever. And you've exhausted it through your housing loans, through your PPF, through your insurance products. There's something that people don't know beyond that. It is National Pension Scheme. So under 80CCD, you can invest additional 50,000 on which you've saved tax. Secondly, just like a mutual fund, and the cost of the fund is the lowest. So if you are more equity oriented, you can choose 60-65% equity, the rest debt. If you're more debt oriented, you can choose a more debt one. So there are 8 players there. We like HDFC, followed by SBI on the equity side. We like LIC on the debt side. So anyone and everyone who wants to save some more tax, the government has given us 50,000 rupees more. While it's not a lot of money, but I still believe that if you're, as it is going to invest, why not invest in NPS? and make superior returns as well as save some tax.
So, you know, that we have that on our big wall and you can look at it there as well. So, the National Pension Scheme is what we're talking about. On the equity side, Anand likes HDFC and SBI. On the debt side, LIC. But assuming that a large part of our audience is between the age of 30 and 40, if someone has a high risk appetite, do you suggest that even within the NPS, it's better to keep a higher allocation towards equity?
Absolutely. See, unlike mutual funds, you can't get out of NPS till the age of 60. Given that you are investing for the long term, I think equity should be where all your money should be. Now, there's no option to invest 100% in equity in NPS, but you should go for the maximum allocation.
So, if I'm investing in equity mutual funds, then what is the difference between the NPS and an equity mutual fund?
I would say two fundamental differences. The first is the fact that you get a tax benefit out of it, which you don't get in mutual funds. The second is the expense ratio of this fund is lower than any direct equity fund as well. So this is like 10 bips is the expense ratio. So it flows to you, so you make more money.
Okay, great. So that's the National Pension Scheme. Got it. The third investment product is direct equity. Now, by this you're referring to buying stocks directly, right?
Yeah.
So in that context, how do you do it? Wouldn't you rather advise just investing in an ETF or an index fund rather than, you know, breaking your head over which stock to buy?
Look, you know, all of us think we are experts, right?
Yeah.
And there's a lot of products that we consume and we believe that, look, you know, there's something that I want to do. And today with the advent of internet, I think, you know, we have an opportunity to learn a lot. Like we have this 1% Academy and we see so many people coming in, enrolling for the courses. There are influencers that people are following. And it gives you a certain thrill to say that I have selected this stock and I have made these returns. So I would say, look, you know, if you're not an expert, it's like if you want to fly, you can be the passenger or the pilot. But if you feel that you can be the pilot, then go for direct equities. Within direct equities, if you are a starter, right, where do I start? Then follow what Warren Buffett does. You know, things that I use on a daily basis and are part of large cap category. Like if I were to start someone, I don't know equity, I will probably go for a Unilever. I'll go for a Bharti or a Reliance.
But does that hold even today? I mean, look at the examples, right? Look, on a daily basis, what do you use? You use Dabur's products, say, for example, Marico's products. But these stocks have been underperforming for years. Something like, say, a Maruti. Of course, you see every second car on the road is a Maruti, but there are a lot of challenges that the sector is facing. So does that still hold that you should buy stocks, you know, based on things you use on a daily basis?
Look, we are a big proponent of passive investing, that if you're not an expert, go for a mutual fund, go for an ETF. But, you know, as I said, you know, people want to try after they've seen some returns, they want to try equities. So if you are not an expert, I still would say that don't try direct equities. But if you have a craving to try it, you know, then do the hard work or follow someone that you feel is the expert. Within that, rather than trying to find the next 20x or 100x, start with a large cap so that you are not disheartened, in a year's time. So I would still say that, look, you know, these companies are great companies. You know, you may lose some money, when you invest for this short period of time. The fundamental principle that if I invest in equities, I have to do it for a period of 5 years still exists.
Okay.
So if you invest in equities, we do it. However, the NSE data is very different, right? It shows that 99% is option traders, and we see a lot of people option trading. That is something that we don't suggest, that if you're not an expert, don't even try that. But direct equities for the long term in blue chip companies, you can seldom go wrong.
Okay. So, you know, I'm glad you said you're passionate or you prefer passive funds, because this is an argument that I've had with every expert, right? I am a big proponent of passive funds. I think I always believe, like, why should you put all your eggs in one basket? Why should you give one fund manager your money where there's a human bias, there is a familiarity bias, there's so many things. Rather than that, just invest in a passive fund, a Nifty ETF. And a disclaimer here that I put a lot of my own salary into passive funds itself. But then what is the deal with active funds? I mean, do you still go there or do you avoid it entirely for the long run?
Look, you know, the jury is out. It's about what creates alpha, right? Yeah. There's a set of active funds which still do it, but a lot of them have not done it. And that's the reason we say, okay, you know...
I think 90% of active funds don't deliver alpha, and we know it, right?
Look, you know, if you go through cycles, you know, people believe that it can happen. Yeah. It's just so happened that it has not happened so much in the last few years. Having said that, I still believe that there are a lot of these stocks which are not still discovered in India. You know, the job of a fund manager or an analyst is to find such companies. And that's the reason, you know, generally as a large cap category, I would say the passive funds are better. But if you want to try the mid cap and the small cap, that's where you try for an active fund. But if you just want large cap, I think it's more of a reflection of Nifty then, it's very difficult for a fund manager to beat or, the index. So the cost of it, today, most of these large cap funds have a 1.5 to 2% expense ratio. So, it's difficult to beat the index by 2% year on year. I would say that, I'm on the same board as you. I would say go for passive funds. But if you want to try small cap, today the best way to go for is a active mutual fund.
Okay, for small caps and mid caps, if you have the risk appetite, right?
Absolutely.
In the large cap universe, there are anyway just a handful of stocks that generate returns. You'd rather invest in passive funds. Got that. Very interesting conversation. We're talking about all the products that you need to invest into in this new fiscal year. We'll take a quick break. Don't go anywhere. We'll also try and address some of your queries that have started to pour in. Stay tuned.